I think we should be very careful. It's easy for America to do us a lot, but if we do too much, it's very hard to see how you recover.
Warren Buffett shared all kinds of wisdom during the 2023 Berkshire Hathaway meeting last week, but most interesting of all was his commentary on the current inflation crisis. This comes as the US reported better than expected inflation this week, but at a rate that is still 2.5 times higher than the healthy target rate. And inflation continues to be a major problem in many regions around the world. During the meeting, Buffett spoke about inflation and how the Federal Reserve is handling the situation, as well as how the current inflation situation has changed how he's investing. Also, I'm trying to reach 200,000 subscribers by the end of the year, so I'd really appreciate it if you could go below this video and hit that subscribe button. This video is brought to you by Seeking Alpha. More on how they can help you invest later in the video. A few days ago, the US reported the latest monthly and annual inflation figures. The inflation rate is measured by looking at how the consumer price index changes on a monthly basis. That is, a basket of goods and services that aims to represent normal US consumer spending. During the month of April, the CPI increased 0.4%, which is a relatively strong reading. Annually, inflation was 4.9%, which is the 9th decrease in annual inflation since its peak in June 2022. And while this is a very welcome slowdown in the rising cost of living, the US is definitely not out of the woods just yet. While overall CPI has declined at a fast pace, core inflation has been much more resilient. Core inflation is a measure of those same goods and services, but excluding food and energy categories. This can be useful in some situations because food and energy tend to be extremely volatile and can actually mask problems in the less volatile categories. While overall CPI increased 4.9% in 12 months, core CPI increased 5.5%. Overall, CPI has been dragged down by significant declines in energy, which surged last year and formed a large portion of the inflation picture. But today, in 2023, while energy prices are easing, pretty much everything else is still increasing at an alarming rate. And even if you ignore everything I just said and assume the good 4.9% rate being plastered across every headline is what we should be focusing on, that's still 2.5 times higher than the healthy 2% target set by the Federal Reserve. And it means inflation has now been above the healthy range for 2 whole years. So what does Warren Buffett think about all of this? Well, during the 2023 Berkshire Hathaway shareholder meeting last week, he spoke about inflation while answering a number of different questions, giving his opinion on why inflation is continuing to be such a problem, whether we should be worried, and his advice for investing in this environment.
When the pandemic broke out, I mean, it was a semi-war-like situation, but nobody knows how far you can go with the paper currency before it gets out of control.
Buffett is talking about the need for the Federal Reserve and the US government to work together during the pandemic to get stimulus to individuals and businesses. The Federal Reserve dramatically increased its buying of US government bonds, which allowed the US government to borrow an enormous amount of money at rock bottom interest rates. Money that was ultimately used to provide relief for households and businesses suffering from the global economic shutdown in 2020. Buffett compared the situation to World War II, another period where a huge amount of government spending was needed in a short period of time.
We did everything we could to prevent inflation during the war, and then the war ended in August of 45, and I think in January 46, and I'm not giving you exact figures at all now, but in January 46, I think the rate of inflation was at something like 1% or thereabouts. And by the end of the year, I think it was at like 15% again.
The reality of ratcheting up spending in a short period of time is that it often results in inflation. This has happened a number of times in the US, and of course, we're experiencing one of those times right now.
I probably would not have been one probably that would have changed the inflation objective to 2% a year from zero. I think that if you tell your people that you're shooting to depreciate your currency, that has a lot of implications, although.
Despite most people acting as if 5 to 6% inflation is fine, Buffett even thinks the 2% Federal Reserve target is too high. The inflation rate in a country is extremely important because it sets the expectations of consumers and ultimately plays a role in influencing how people spend their money. If inflation is persistently high, it drives people to buy goods and services before their prices surge even higher. And high inflation for a long period of time eventually erodes consumer confidence in the currency entirely. The consensus for monetary policy is that some small amount of inflation is good, because it encourages people to either spend money or invest it, which ultimately drives the economy. But Buffett is acutely aware of the issues that can arise if inflation isn't handled quickly.
I think we should be very careful.
Just before I get to the next clip, my buddy Brandon, who I'm currently in the US with, is going to tell you about our trip sponsor, Seeking Alpha.
Hamish and Brandon's Berkshire Bonanza 2023 is brought to you by Seeking Alpha. Try Seeking Alpha Premium today to access Seeking Alpha's rating system, valuation breakdowns, 10 years of financial data, unlimited news and analysis articles, plus have earnings call transcripts, investor presentations, SEC filings, and press releases all in the one place. With the suite of tools that come with Seeking Alpha Premium, you can be confident no matter what company you're looking at, you'll be able to get up to speed fast. But the best thing about our partnership is if you sign up with our referral link, you can access a 14-day free trial of Seeking Alpha Premium. So go check them out, give Seeking Alpha Premium a go for yourself, and now let's get back to it.
Ultimately, the Federal Reserve has a lot to do with handling the inflation crisis, primarily by the decision to raise the federal funds interest rate and slow consumer spending and business investment.
Nobody understands the situation better than Jay Powell.
Buffett at the meeting indicated that he has full confidence that Jerome Powell is the best person to have leading the Federal Reserve. Powell now has increased interest rates at every meeting since March of last year, raising the rate from 0.1% to 5.25%. And it seems to have had an effect on the rate of inflation, although the effectiveness depends on how you look at the data. If you look at the headline inflation number, it's fallen considerably since the rate hikes began in early 2022. But you could also consider the decline in energy prices as more of a reflection of supply bottlenecks easing rather than rates slowing consumer demand. And if you're in that camp, then you'd be looking at core inflation, which has also been declining, but at a pretty slow rate considering the dramatic increase in interest rates.
I do not worry about the Federal Reserve, and I think it's fulfilling the functions for which it was established. But he's not in control of fiscal policy, and every now and then he drops a few hints.
There is one other element to think about when it comes to discussing inflation, and that's US government spending. I spoke about this in my recent Charlie Munger video, so I won't go into a huge amount of detail here, but the one barrier potentially holding the Federal Reserve back from reducing inflation is government debt. As long as inflation is well above the healthy range, the Federal Reserve should be raising interest rates. The problem is that every rate hike puts more pressure on the US government and their huge debt burden. According to analysis by the Peter G. Peterson Foundation, interest payments on debt represent 8% of total government spending in 2022 and is expected to rise to 14% by 2033. And that's even with the assumption that inflation is back to 2% by 2024, which certainly isn't a given.
Well, I don't think the Federal Reserve is the problem, and I think they can't solve the fiscal problem.
The US government's appetite to spend more than they receive in tax revenue is something that the Federal Reserve simply can't control. The problem with the current level of spending is that everyone is gambling on the expectation that inflation has peaked. And the truth is, we really don't know if it has or not.
It's easy for America to do a lot, but if we do too much, it's very hard to see how you recover.
If you want to learn about the consequences of this situation taken too far, I recommend checking out last week's video where I discussed Argentina's economic crisis. But finally, what is Warren Buffett's advice for how to invest during this inflation crisis? During an interview from a few weeks ago, he gave some excellent insights into the situation.
We don't make our decisions as to whether to own part of a company for the next 20 years. We don't have any idea what anybody's going to do next week or next month. And when I was buying Berkshire between 1968 in 1965 of control, it didn't really have anything to do with it. All kinds of things were happening in the economic markets all the time, but we haven't changed our course.
Inflation isn't one of the factors that Buffett considers when he's buying businesses. And fundamentally, that's because he doesn't know what inflation will look like in the future and how it will ultimately affect the stock market.
We don't know how to profit by looking at broad statistics and guessing what stock markets or bond markets will do.
How the stock market moves on a monthly or yearly basis is at the mercy of macroeconomic factors like inflation, unemployment, interest rates, all things that can't be predicted. So it's not possible to be a successful long-term investor by trying to predict short-term trends.
We don't make stock market guesses.
Instead, Buffett focuses on buying high-quality businesses at reasonable prices.
We just want to buy good businesses, run by people we like and trust, and at a decent price.
A good business means one that can thrive in a variety of economic conditions, including high inflation. And when it comes to high inflation, that means only investing in businesses with a deep economic moat, some kind of intrinsic layer of protection that allows a business to continue raising prices even as their costs increase. The businesses that will be most badly affected by the inflation crisis are those that sell a product or service that isn't unique. If a customer can substitute a product for a cheaper competing product, it's going to be very difficult for that business to raise prices to offset their rising costs, simply meaning they become permanently less profitable even once inflation eases. But how do interest rate hikes fit into all of this? Because after all, Buffett said in the past that interest rates act like gravity to stock prices.
Well, we're in a way different position than we were when essentially what the option was to get 4 basis points on bonds, and that changes the value. It changes the value of real estate, changes the value of equities. It changes everything. But that's all happened in my lifetime, various ways.
High interest rates does change the value of businesses because their alternative investment opportunities are much more attractive now. For some businesses, that change in value has been 50 to 80%, but for others, it'll be less significant. If a business produces a ton of free cash flow and has the ability to reinvest and grow, and also can be a business that's purchased at a reasonable price, then interest rate fluctuations won't have a meaningful impact on its performance. In the end, regardless of whether you're trying to pick individual stocks or are simply investing in index funds, the short-term macroeconomic situation should be the last thing you care about. If you're investing consistently in good businesses or the entire market, while the short term is unknown, you'll very likely do well over time.